AI costs $50 to $60 billion per gigawatt, and we need 70 gigawatts to be built in this country just to meet the demand that's already on the books. Hey, it's KP coming to you live from Corona, California. It is Monday night. It's about 10:30 here, and wrapping up a long day. First day at my desk in 11 days, and then I'll be gone for another 14. So lots of travel. Got my PRMG Goes Platinum. We had in 2022, we went to Nashville, our retail leadership conference. Big conference, 100 plus people from all over the country meeting in a spot. Pretty cool. I wore that today during our TPO mid-year managers summit. So we have about 7 managers, regional managers and sales managers on the TPO channels, correspondent and wholesale, which the correspondent includes non-delegated and delegated. And they're in town. We come in once a year. We do a little checkup. How are we doing against the budget forecast from December? How are we looking to course correct for the rest of the year? So far, things are looking decent. However, I think everyone did notice, and this is, across all channels, rates are high, and we were rolling into that seasonal downtrend in purchase business. Now, each of the last 2 years, we saw a little pop in refinance business to finish the second half of both those years. Need a little help from the Iranian conflict to see that. And or else we're going to be grinding it out. So sharpen up on your products, non-QM, equity lending. I think I read somewhere today that balances on home equity lines of credit rose by $13 billion from the first to the second quarter. That's totaling $459 billion, according to the Federal Reserve Bank of Florida. HELOC balances have been increasing for the last 17 quarters. Limited reviews going away at the GSEs, no problem. We got non-QM programs for that. I know there's a great medical professional program that we just rolled out, and some people in the industry are starting to roll that out too. And, so we just got to get back to blocking and tackling, calling, relationship building. It's not that there's no business out there. It's just, it's a little less business. And so just got to grind through it. It's like it is in every normal year, unless, of course, we get a refi uptick. Now, the broader economy is having a jobless boom. We know we've been talking about a no hire, no fire economy. What's interesting is because we don't have population growth or immigration, we have kind of an even population. And so I heard on some CNBC clip last week that the Fed is now looking at normal jobs reports from the BLS on the first Friday of the month is to have no job growth up to 30,000. And that's normal. And it seems pretty low. But based on the population not growing as much, especially also with less immigration coming in, that is keeping on par and pace job growth right there. I thought that was interesting. Now, AI is all the talk. Is it going to continue to boost worker productivity? Yes, but there's a lot of build-out yet to be done. The hyperscalers are out there building. Not a financial advisor, not responsible for your losses, only your profits. But it's earnings season. We still got a couple big ones left. Broadcom, and of course, NVIDIA pretty much ends it. And then we roll into, the fall and midterms, and things get a little choppy, potentially. So in that AI build-out, is it complete compute class as an asset class? There's a lot of infrastructure. It's kind of measured in gigawatts, how much compute can be out there, power, those kinds of things. AI costs $50 to $60 billion per gigawatt, and we need 70 gigawatts to be built in this country just to meet the demand that's already on the books. So maybe last week you might have seen how NVIDIA went and lined up some of the largest liquidity players on the planet and got $500 billion of financing. It's kind of like getting a warehouse line to help fund your business, although it's really for NVIDIA's customers to get credit from BlackRock, Blackstone, Morgan Stanley, KKR, Goldman Sachs, the list goes on and on, Morgan Stanley. So there's a lot of money floating around out there. People aren't saving money. People are spending all their money. We know we had inflation reports last week. and followed by the July retail sales report. I'll get into that in just a second. But, one last point on the AI trade. The internet traffic, from humans will be a rounding error. I read this pretty interesting post that someone put out there. So AI bots that are out there doing stuff on the internet, whatever it is, whether it's an agent booking your travel for you or just trying to put fake comments to make you think this page is really awesome, whatever. Bot traffic has now surpassed human traffic on the internet. In the next 5 years will be 1,000 times greater than human traffic. So we are building up for the bots to take over. Don't be scared. July sales fell 0.6 from June. I mentioned that last week, but I thought it was cool to just kind of double click on that. Gas was down. Even though it fell, it's still at a pretty high level. So, it's still at a pretty decent level. People are spending. And, we don't have a demand problem in this country. So, will this retail sales number keep coming down, plus those jobs I mentioned, to just keep inflation on this glide path into next year, getting us closer to the 2% target? Consumer goods was down in the retail sales 0.4%. And that's pretty interesting. I thought tariffs were supposed to boost everything up. Anyway, on the CPI, I thought it was interesting that the 3-month core CPI is at 1.6%. That's below the 2% target. And annualized, and 2.4%, it's on a 6-month basis, not too far. So kind of all the Fed's projections, the dot plot, if you will, in a year from now, we're going to be around 2% anyway. Of course, they go by the PCE core number. Energy prices fell. They're kind of holding steady. We'll see if that changes. Airline fares jumped. That was interesting. Grocery prices rose by 0.1%, the lowest pace of gain since March, with prices for meat, fish, eggs, and fruit declining. I'm not sure if you're noticing that. Existing home sales, 4.6 month supply. We know that's every market for themselves. Median home price, $434,000, which is 2% higher than a year ago. Median's kind of it's just a number to know. It's not like, the end all be all. Okay, so I'll get into one more thing. When I was at the Western Secondary, David Batney from Guild, who's awesome, been a lot of meetings with him, and he had a panel, and it's pretty interesting talking about credit scores. We talk about, our scores that we're seeing now in this industry. Are they inflated? Are they accurate? For every 40 points of credit score, so let's just say that like the real score is this, but it's, you got a 40 point, inflated score, default's double. So something to think about. It's not just because of score, because of that borrower and their credit profile. So I thought that was very interesting. A lot going on. Keep grinding through it, blocking and tackling, build relationships, grinding through deals. Talk to some originators today, and some deals are a little tougher on the edges right now. But you know what? This is what we're here to do. We're here to serve our community, even through the tough times for our consumers, and of course the seasonally slower times, but better times ahead. To quote my friend Bill Bodnar over at Tabrasa. Have a good one. Cheers.
Hey, it's KP coming to you live from Newport Beach. Here we go. We are, what up, Anthony? Oh, let's go. We just had our first inaugural TPO advisory board and client appreciation event. It's kind of winding down, and then my dumbass is like, oh, I have to do my Thursday night LinkedIn video. So I apologize for getting this one out late. There was a bigger crowd earlier, trust me. Okay, lots going on, and I will try and be brief. Don't have a whole lot to talk about, but you will get the pier and an ocean view here in just a second if you're still sticking with me. So we talk a lot about the Fed put, where the Fed kind of puts a floor on the market and says, like, this is as high as we'll let yields go, or as low as we'll let the stock market go, or this is the lowest we'll let the economy crumble with jobs slowing down or whatever. But the Fed has taken a different stance, so and they are
really canceled out.
Not they said they don't want to be the referee. And so what was interesting yesterday is the U.S. Department of Treasury made an announcement. I know you probably read about it, and I got a little hot take on it. But the U.S. Treasury Department, they buy about $2 billion per operation when they're buying bonds that run off the balance sheet, and they doubled it to $4 billion. It's not a huge move. It's more of a symbolic statement. And so do we have a Treasury Department put? Is it the Treasury put now and not the Fed put? So it's a very interesting thing to talk about. I haven't heard anybody say it, but it was just like a little phrase that came to mind. It also is a statement that the 30-year long bond has gotten too high. So at 530, 532, that's gotten a little too high. So there was a little dip yesterday, and rates improved, 10-year Treasury improved, locks improved, but that faded today, and I'll explain that in just a second. There we go. Ben Carlson died in 2014. He's a lifeguard that died right out here where I'm about to show you, saving somebody, unfortunately. Lots of history here in Newport Beach. We got this little thing right here, and this little path you can walk down, and shows all the history of Newport Beach. I'm about to walk the pier. We got the moon out. You can see the moon. So the other thing, the reason why that reprieve in yields faded is because the statement is like, rates are too high and we have a fiscal problem. And so the Treasury Department trying to put a put in there and a floor on the market and keeping yields from rising is basically an admission that they are too high. But the real problem is fiscal policy, not monetary policy by the Fed, but fiscal. So we are spending more than we take in, and this administration wants to grow our way out of it with higher GDP and tax revenue, and it hasn't happened yet, and we keep spending. We surpassed $40 trillion on our federal debt. So it's gotten out of control. So inflation is systemic and sticky. Even if the CPI and PCE prints show that they're not going up as much, and that inflation is coming down with or without tariffs and the Strait of Hormuz. So it impacts mortgage rates, and that matters. And so we hit a wall about 2 weeks ago with locks and business. It's seasonally slower with purchase business this time of year. And then, of course, rates being, at 1 year highs. We're just loading up for future refinances whenever that comes. But the fiscal policy is the problem right now. And so we'll keep an eye on it, and we'll continue to monitor it and go through all that. It's actually a light economic week, and even the stock market's taking a breather. There's some consolidation phase going. Earnings season still going on. Should end early September, late August. NVIDIA will report, and that'll pretty much be it. And then it's time to start focusing on the midterms and see how people feel about their pocketbook. And so we'll keep an eye on that. But man, there's still so much business out there. I don't want to sound like doom and gloom. People need a roof over their head. They're going to pay the going rate. And one of the things we talked about, grasping on a non-QM. Fannie and Freddie got rid of the limited review policy. Condo's going to go to non-QM a lot more. Grind it out through that. Equity lending continues to rise. And still have a beautiful view of the ocean. So we'll keep grinding through it. We'll get back to you next Monday. I will be at the Blend Forum, and I'll have some stuff to go over then. Speaking of oil and Strait of Hormuz, the administration put out some data saying that, remember, it's not binary, open or close the strait. They say about 10 million barrels of oil are still going through the strait. It's about half of what it was pre-war. So there's a southern route near Oman that is, being used to reroute tankers and get oil around here. And so that's why, oil's rising a little bit this week, but it's not like completely volatile and rising at a crazy number. Oil is one of the most correlated things to the stock market. I am not a financial advisor. I am not responsible for your losses, only your profits. Oil goes up, stocks go down. That's kind of a general rule. Excuse me. And they haven't been going up that much compared to what we saw a couple months ago. Because there is still a flow. People, China, us, other countries, we're going through our strategic reserves, petroleum reserves. So those will come home to roost at some point. We're going to watch that and see if this conflict ends. Anyway, we're at 6 minutes. I'm done. Have a good one. Get back to you later from Austin, Texas. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.